Like nearly every single stock in the market right now, Walgreens Boots Alliance is nearing its 52-week low. It's currently trading at $43.99 per share, and we can see they are currently down 17% year to date. Now, this is a major dividend growth stock, so in this video, we're going to be jumping into my stock valuation spreadsheet to find the intrinsic value of Walgreens and decide if it's a stock we should be buying or selling. And on this spreadsheet, we have 4 different valuation models. We have Graham's valuation, we have a discounted cash flow model, a multiples valuation, and a dividend discount model. And all of these valuations will roll into our output tab. So let's go ahead and jump over to our stock screener. If you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description. So before we jump into the analysis, it is worth noting that Walgreens did recently release their Q2 earnings. And as we can see, Walgreens Q2 earnings on March 31st did beat analyst estimates. The drugstore chain reported adjusted earnings of $1.59 per share, which is up 26% from the previous year, and revenue also climbed 7.8%. So that's all a good sign for Walgreens. Now we're currently looking at a 250-day chart. Let's go ahead and zoom out a little bit more and look at a 500-day chart and hit enter. And we can see it's gone up quite a bit, but it's gone back down to its recent lows about 500 days ago. If we come over here and look at its dividend data, we can see they're paying out $1.91 per share, with the dividend yield currently at 4.34%, so a pretty high dividend yield, and their payout ratio is currently sitting at just 26%. Now, their 20, 50, and 200 and moving day averages are all down. Their 1-year return is currently at negative 20%, and their 2-year return at 5%. Now, analysts currently have a price target of $48.52 per share, but let's go ahead and jump into our valuations to see if that's accurate. And the first valuation model we are going to look at is Graham's valuation, a valuation model invented by Benjamin Graham, who is one of Warren Buffett's mentors, and we can see the formula he laid out for us right here. So the first thing we need is the earnings per share of this stock, which for Walgreens is currently sitting at 7.25, where they're going to take 7, which is the price to earnings of a company with no growth, and multiply it by a growth rate. And analysts are currently looking at a growth rate of about 2 for this stock, which is pretty low. We're then going to look at the average yield of AAA corporate bonds, which is 4.4. So we're then going to take all those numbers and multiply them together. After this, we're going to divide by Y, which is the current yield of AAA corporate bonds. And at the time of this video, it is 4.18, which is the highest it has been in quite some time. Earlier this year, it was lower than even 3. But after plugging all of this in, we can see the intrinsic value, according to Graham's valuation, is much higher than the current price, $68.68. But let's go ahead and look at our discounted cash flow analysis. And in order to perform our discounted cash flow analysis, we need to project a growth rate for the future free cash flows for the company. So what I've done is I plugged in the historical free cash flows for Walgreens, which allows me to see the growth rates year over year, which I have listed out right here. And the average growth rate over the past few years is sitting at about 2.4%. So that is a pretty slow free cash flow growth rate. I'm projecting a growth rate of about 2.5% moving forward. So I use that growth rate to project forward the future free cash flows of the company, then use it to calculate the terminal value, which is the sum of the free cash flows past the year 2030. I then took the present value of all of these future free cash flows and added them together, which you can see right here. I then added Walgreens cash and cash equivalents and subtracted out their total debt, which gave me their equity value right here. After I had their equity value, I divided it by the number of shares outstanding, which gave me a discounted cash flow price per share of $50.27. Now let's go ahead and jump over to our multiples valuation. And I originally tried to perform a multiples valuation on Walgreens, but I really didn't like the comparables I was receiving for Walgreens. I didn't think it provided a fair valuation, so I decided that this would not be a valuation model that would perform very well with Walgreens. Now let's go ahead and look at our dividend discount model. And essentially the idea behind our dividend discount model is we can value a stock based on how much they pay out in dividends and how much their dividends are growing. So what I've done is I plugged in how much their quarterly dividend payouts have been over the past few years, so I could see their yearly dividends, and this allowed me to see how much their dividend was growing over the past few years. So we can see 2018 to 2019, 10%, to 2020 at 4%, and the past 2 years sitting at about 2%. So over the past few years, their average growth rate has been sitting at about 4.6%. So that's decent dividend growth. There are companies with better dividend growth than that, no doubt. So I'm projecting forward a growth rate of about 4.25% for their dividend growth. After applying a discount rate of about 9%, we can see their dividend discount model price per share is currently sitting at about $42. Now let's go ahead and jump over to our output tab. And here on our output tab, we can see all 4 of our valuation models. Graham's sitting at $68.68. We don't have a multiples valuation. Our DCF model gave us a price per share of $50.27, and our dividend discount model a price of $41.96. So when you average all three of these together, we can see our intrinsic value is now $53.64, which is higher than the current price of $43.99. Now, I am a value dividend investor, so I like to play a margin of safety of about 20%. So I'll hit enter, and based off of this, we can see our acceptable buy price for this company is about $42.91. So our valuation model is telling us this is not a stock we should be currently buying. Now, that current price is very close to the acceptable buy price, so that is something worth keeping an eye on if you're interested in Walgreens. Personally, I think the growth rate for this company is something that's a little bit alarming to me. I think from a dividend growth perspective, clearly they have a low payout ratio, which is a great sign, and a pretty good starting dividend yield, but I would like to see a company that has a little bit more growth projected into the analysis. So personally, I'm not currently planning on buying Walgreens. If it does go a little bit lower, maybe I'll start to consider buying in, but go ahead and let me know what your thoughts on Walgreens stock are in the comments below. If you'd like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. There you can gain access to a private Discord. Also, be sure to go ahead and follow me on Twitter if you'd like to keep up with my dividend investing journey. So with that being said, thank you guys so much for watching this video, and please don't forget to like and subscribe to the channel.